Welcome back, everybody. So this video is going to be for everyone who plans to buy a house in the near future, sometime in 2025 or beyond. I'm one of those people. I want to buy a home sometime this year. So for that, we want to first start off by figuring out how much home we can afford in this 2025 market. With the dynamic change in interest rates and the uncertainty in the market, we just want to, figure out what exactly we need to do and the rules we need to follow to know how much we can afford. And that's what I'll be talking about. So first, I'll get into all the factors that factor into home affordability and figuring out how much home you can afford. And then I'll follow it up by giving some examples of scenarios, including my own, to show how much we can afford when looking for homes. And this is going to be a part of an entire series of me on my home buying journey. So if you're interested in just seeing how the home buying journey plays out in its totality, just follow, subscribe, and just keep up with it because I'll be kind of documenting it. All right. So the first and most important factor that factors into home affordability is your debt to income ratio. What that basically is basically your total amount of debt compared to your total amount of income. So for example, that's all your recurring expenses, whether that's your housing, renting, or mortgage, your car payments, your student loans, your childcare costs, all as a percentage of your total amount of income you bring in. So if you want to know what a good number is for where to shoot for that, what we'll look to prominently is the 28-36 rule, where it states all your housing costs basically shouldn't take up more than 28% of your monthly income. And then all your debts combined shouldn't take up more than 36% of your total monthly income. So if we're using some examples, let's take, say, a $10,000 monthly income. Your housing costs shouldn't exceed more than $2,800 with the mortgage / rent, property taxes, all that combined into one. And it also shouldn't exceed $3,600 of all your expenses when you factor in other things like a car note or whatnot. And you want to stay under this number so you can feel comfortable and know that you can pay your mortgage and all your expenses comfortably without worrying and going into debt. So moving on, let's talk about the next factor into home affordability, and that's your credit score. It isn't as big of a factor nearly as much as your debt to income ratio. But as you can tell by everyone kind of talking to you and encouraging you to keep a high credit score, it does factor highly into the interest rate that you would have for a mortgage payment. And that changes your monthly payment significantly. The difference between a mid 500 credit score and a high 700 credit score can be up to over a half a percentage point off your interest rate that you get for a mortgage from a mortgage lender. And to show you how an improved interest rate can help you, let's just take an example of a mortgage of, say, $300,000. If you had a 7% interest rate, you'll be paying about $100 more than if you had a 6.5% interest rate. So that's $100 extra each month that you will save just by having a better credit score. So if you haven't yet, start looking at means and methods to improve your credit score so that when you're in the position to buy a home and when you want to start sitting there with mortgage lenders, you have as stronger credit score as you could possibly have so that you can have the best possible rates that you could possibly have, ultimately having the lowest mortgage payment that you could possibly have as well. And the last factor going into home affordability is, of course, the down payment. The more money you can put down into a home, from the start, obviously lowers your payment significantly from the jump. So as a baseline, you have to put down about 20% on a conventional mortgage if you're going that route. But there are also options to secure a home with a lot less money put down. Say for FHA and VA loans, you have to put down somewhere around 3.5%. And there's also unique cases like myself when I bought my first home that I was able to secure the home with a 0% down payment on my home. But because you do have a big variance on your options as far as down payment from 20% down to 0%, you want to make sure that whatever option you're going, you're still able to cover the mortgage payments on the home. And while if you get a 0% interest rate, it'll significantly increase your monthly payment, it will also add something called PMI or mortgage insurance. So mortgage insurance is basically a required monthly payment that you as a home buyer has to make because you didn't, back your mortgage and pay 20% down on your mortgage from the start. So you kind of have to secure your home in a stronger way, requiring this mortgage insurance to be applied to it. So with those examples in mind, let's give some examples of home affordability and how much people can afford. And then I'll show you how much I plan on setting my limit at as far as home affordability going forward on my home buying journey. So let's get it. So for the purposes of this, we'll be using Zillow's home affordability calculator to kind of give an example of what someone could afford, based off a certain salary. And then I'll show you how much I plan on setting my limit to as well based off my numbers. So let's look at the numbers we already have in here as an example. Let's say this person had an income of about $70,000 a year and they have a monthly debt of $250, let's say they have actually a payment of $400, let's say they have a car payment that much, and they were to bring a $20,000 down payment to the table, and they wanted to have a debt to income ratio of about 36%, and they were able to secure a 7% interest rate on their home. So based off these numbers, a person with about $70,000 annual income a year can afford a little over $200,000 on a home comfortably, and their monthly payment will break down into about $1,700 every single month. And that seems like a stretch, but it is affordable in a lot of cases, especially based off this person doesn't have a lot of other debt going on. But let's say this person wanted to afford, let's say, a $300,000 home. So for this, you can look at several factors to get to that point. You can look at their monthly debts. Could they get that number down? You can look at their down payment, and you can look at also their interest rate to see if they can lower that. So if you were to eliminate all your other debts on it, then you could comfortably at that point afford $250,000. But then let's say if you were able to secure, let's say you had a great credit score and you were able to secure a 6.5% interest rate, then you could afford about a $270,000 home. But let's say you were able to bring a whopping $70,000 entire year's worth of salary to the table. Then boom, you got to your number, you were able to afford it. So you can kind of play with these numbers and kind of figure out exactly how to get to the point you want, and also how to not shoot too high so that you can't afford the home when you eventually get it. All right, now let's look at my numbers and how much I plan to set my limit at when I'm looking for a home this year. So let's say I can comfortably, with my household income, bring in about $125,000 this year, and I have roughly a monthly debt of all the recurring expenses between car payments and student loans of about $750 every single month. And I'm also planning on bringing over $100,000 to the table when I do buy. In between me and my wife, we have a excellent credit score. So let's say hypothetically, we don't know where interest rates will be at any point in time in the future. So let's say we can secure a 6.5% interest rate. Based off this affordability calculator, we can afford a home up to $480,000. And I think that's a pretty solid number. That's kind of the number I had in mind from the start. So let's look at a couple of the factors to make sure that that number is as strong and as solid as we want it to be. So there's a couple other things that factor into, your monthly payment, your property tax, your insurance, as well as your mortgage insurance if you were to have it. But in this case, we were to bring $100,000 to the table. So that would kind of make up that 20% down payment that you would need to not have mortgage insurance. So let's look down at these things. I'll say property tax, which is pretty accurate. It's roughly around 1.2% property tax on your home. So that number is good. Then we look at home insurance. Home insurance has been going up rapidly over the past couple of years. So let's conservatively estimate that our yearly home insurance would shoot up to about $2,000. Okay. Then that brings our number down, slightly, but I still like the conservativeness of locking that in so that if insurance was to rise, we'll still be in a good situation. So lastly, let's look at HOA. HOA is basically homeowners association fees that if you were to move into a nice neighborhood that may have a pool, a playground, a community center and whatnot, they may charge you a HOA fee just to maintain those things. So let's say I end up in that situation and my HOA dues are, let's say, $50 a month. Then again, that brings down my monthly affordability by a decent amount, but nothing too strenuous. So based off those numbers and based off some research that I've done prior to this video, I plan on setting my limit at $450,000 in my home search. And I think that's a conservative number, so it won't put me at a point that I'm struggling to be able to cover these payments, and that I could still build my savings and build my investments and retirement accounts on top of this while owning this much of a home. And it's also worth noting there's several other factors that factor into home ownership and buying a home that I'm not going to get into in this video, like closing costs on the home, moving expenses, home inspection, and whatnot. And if I haven't mentioned it already, this is my first time buying a home, and I made a lot of mistakes on my first home buying journey, including like not having the right real estate agent, not doing a lot of the good prep work, and not being involved enough in my process. So if you want to see and know some of those mistakes so that you don't make them yourself, refer to this video so that you can learn from my mistakes and have a better, more effective home buying journey than I did the first time. Thank you.